there going to be some sort of dirty, horrible compromise that everyone's a bit stinky-nosed at, but it appeases the markets, or is this going to get into something worse? We have to wait and see. So the markets have been thrashing around trying to digest news flow, which is always why I've said be careful of trading geopolitics. But there are more structural things going on that are interesting. Obviously, equities are still in a bear market. Whether they're trying to find a low or there's something bigger, we don't know yet. My thought process is it's probably more likely to be getting closer to a low. But if we start playing out the full recession card, which the yield curve doesn't yet suggest, then okay, that could be different. So I'm looking at that. I'm looking at the dollar. I'm looking at the bond market, looking at gold, looking at crypto. So there's a lot of things to look at.
Yeah, and much to talk about. By the way, I should say, Raoul, the comments in YouTube right now are flying by so quick that I'm having a hard time scrolling on them. But we should say we are doing an extended Q&A after this ends, I believe at 6:30 p.m. Eastern time on Twitter Spaces. So don't miss that. We're going to cover some of your questions here, but much, much more to talk about. Raoul, you talked about the bond market. I know you're thinking about this as a reflection on valuation, a reflection on geopolitics. What are your thoughts right now on the bond market?
So I have been following something called the chart of truth, which is the long-term trend in 10-year bond yields. And it has a couple of times got to 2 standard deviations overbought. I don't know if Brian's showing the chart now, but yeah. 2 standard deviations overbought. But generally it gets this kind of zone between 1 and 2 standard deviations overbought, and it reverses. So, okay, we should be on alert for something changing in bond yields. Why? Everyone's screaming inflation, but I think of the inflation at 8% as a massive tightening of monetary conditions, because neither corporations nor people can offset it with increase in earnings or cost rises, price rises. So what you've got is a tightening of monetary conditions, particularly on lower and middle income households, because the earnings gap is massive between wage growth and the inflation numbers. And that tends to slow growth, and we're seeing forward-looking indicators suggest that growth is slowing down quite fast. And that will play out not immediately, but in the next 6 months. So I'm looking at this thinking, could everybody be kind of wrong at bonds? I mean, the last time it got to 2 standard deviations was when Jeff Gundlach was talking about yields going to 6%. They didn't. People are now talking about a structural shift in inflation. Is it possible? For sure. I still think the probability lies in the chart of truth. So then something else is going on in the bond market, which is the yield curve. Now, everyone's talked about this, but this is a really nice chart that shows the yield curve. Now, it goes up and down. It goes 300 basis points on the upside and maybe negative 50 on the downside. And usually when you get to negative, maybe a year later, you get a recession. So what's weird this time around, it's kind of peaked really early, which plays into the argument that I'm having that monetary conditions are actually, the inflation is actually essentially like rising interest rates 200 basis points already. So once the Fed start to rise, on the next chart, you can see what happens. So Brian, if you flip to the next chart, so these are the last 2 rate rises, and the yield curve is in orange. The yield curve flattens as soon as they start rising. So we're currently today 25 basis points from a yield curve going to 0. So I can't see how you can get interest rates to rise more than 50 or 75 basis points before you've actually created a recession. So that makes you think that if that's the case, that the forward-looking indicators suggest that there's going to be a potential recession ahead, then normally demand destruction comes. Along with the rise in prices causes demand destruction. The answer to higher prices is higher prices, is an old commodity market saying. So therefore, bond yield should come off, and particularly at the long end, because the long end is essentially the inflation element of it. So if we go to the next chart, here's the chart of TLT, which is the 20-year essential equivalent ETF. This looks like it's a big wedge pattern. It's right at the bottom of the range, and wedges like this, these triangle patterns, tend to lead to breakouts one way or the other. I think the balance of probability with a slowing economy, a risk-averse world, and inflation likely to peak over some point. I understand that the geopolitics has clouded that issue somewhat, that this looks like it's an interesting risk reward when everybody in the world hates bonds. So that's something I've been focused on.
You know what's so interesting about that chart series that you walk through is you start with literally the 40-year chart, the chart of truth, looking back over 40 years. Really extraordinary to see that steady rate decline, and then coming into the 20-year chart, and now here looking at a little bit narrower here at TLT.
That's how to build a macro framework. You have the secular trend, the cyclical trend, and then where we are now, where you start using technical analysis. That's that's how I've always approached markets, because I tend not to like to trade against the secular trend. So I'm almost never short bonds until we prove that the secular trend has changed. So when I see all of these things added together, I could have overlaid DMARC indicators, RSIs, where we're seeing divergences. Things are stacking up to, you know what, maybe the macro picture is going to change for bonds.
Yeah, absolutely. And that's what you are able to do with macro. Really interesting also to contrast that with some of the things that you've been saying about the geopolitical situation, which I think is so interesting. One of my favorite quotes was you saying, don't get too clever, don't get too cute, don't get too brave. This stuff is almost impossible to predict in the short term.
That's right. But let's think about bonds here again. So let's assume that things get worse. We go to my scenario 2 or 3. Okay, that's a more risk-averse world. So the most risk-averse asset in the world is the US bond market and the US dollar. We've seen the dollar scream higher because of this. So everybody's record underweight pretty much the bond market. So therefore money comes into the bond market. And we've seen those kind of moves in stuff like 9/11 and others where, you know, those kind of events move bond yields. Okay, let's assume the other side. Let's assume that there's a truce that gets called tomorrow. Well, we're going to see crude oil down significantly, et cetera, as people start to think, well, the Europeans will cut a deal and they'll be able to get oil and gas and commodity prices will flow, in which case those things turn around, and in which case the inflation pressures come off, bond yields fall. So I kind of feel like we're in a sweet spot, unless I'm going to be wrong. We can see where I'm wrong on that chart, roughly speaking. And that would be if there is a structural change in the entire bond market dynamics. Now, in 10-year bond yield terms, could it get to 225 and still be in the chart of truth? Yeah, fine. So, but it kind of feels like we should be looking for the change.
Yeah, you're talking right now about 10-year Treasury yield, which is trading at almost exactly 2% right now, I believe, as we have this conversation.
Yeah, and you can see, Brian, if you flip up the chart again of the chart of truth, you can see that, you know, we're in the zone. It could chop around, or it could make a burst for the green line, which is the 2 standard deviation kind of overbought versus the regression channel. So that's I think interesting to me.
Yeah, we just lost the 2 handle since we started. 1.995 right now on UST 10-year Treasury yield.
Yeah, there you go.